Hey, it's Tom here and welcome back to the channel. It is monthly Q&A time here yet again on the channel. I put up a community post a couple of days ago to collect your questions for this video. So thank you to everyone who did ask a question for this Q&A. If you haven't watched one of these videos before, I try to do these Q&A videos on the channel about once a month. So just keep an eye out for new posts on the community page for the channel here on YouTube. You should be able to turn channel notifications on so that you get notified whenever I ask for questions for a future Q&A video, and that way you'll be able to get in quick, ask your question, and hopefully be featured on a video. So thanks to everyone who did ask a question. Like I say, I'm going to just roll the camera for 20 minutes or so here and kind of see how many we can get through. Now, before we get into the Q&A, we do have a sponsor for today's video, and this video is sponsored by ShareSite. ShareSite is the portfolio tracking and tax reporting tool that I've been using for several years personally at this point. It allows me to calculate very accurately the real returns from my portfolio, considering capital gains or losses, currency fluctuations, and also dividend income. And additionally, it allows me to run my tax reporting really simply each financial year. Here in New Zealand, we've just got to the end of the financial year, which in New Zealand here ends in March. That means I can run a couple of basic tax reports out of ShareSite, ship them off to my accountant, and it's far less of a hassle to get those kind of key tax numbers than it would be otherwise. If you're interested in checking out ShareSite, there is a free version that you can use forever by heading to the link sharesite.com/investingwithtom. Additionally, that link will get you 4 months free off of an annual subscription to ShareSite should you choose to upgrade for more premium features. And a thank you to everyone who has used that link to sign up to ShareSite. It directly supports me and the channel, so I'm very appreciative of that. But with all that said, let's get straight into this video and answer some of your latest questions for the Q&A. First one here is from Sebastian. Hey Tom, greetings from Germany. Really appreciate your content. Thank you very much. Regarding HIFS, that's Hingham Institution for Savings, interest rates are rising sharply, which is increasing the cost of deposits. Could you elaborate on your thoughts of a potential time lag with which HIFS will be able to pass this on to their loan portfolio and the impact for earnings power over the next few years? How do you see the current valuation of around 1.3 times price to book as an entry point? Sure. On the valuation part, as the channel's kind of getting bigger, I'm trying to steer a little bit further away from giving specific valuation on specific stocks. So I don't have too much to say on that last point around 1.3 times book. I do have valuation videos here on the channel and even specifically bank valuation videos here on the channel. So you're welcome to check those out. I'll try to link actually the bank one up in one of the corners here so you can see that. That's kind of a decision you'll have to make yourself. But yeah, essentially for those unfamiliar with Hingham, they're a small regional bank that really specializes in real estate lending, largely commercial, but a little bit of residential real estate lending as well. And as you probably are all familiar, by the nature of real estate loans, they tend to generally be longer term loans. Since they are commercial, they do have probably a higher portion of adjustable rate loans than a lot of fixed term loans like you might see with more residential owner occupied type real estate, lending and that type of thing. But I did look up the 10K just before this video. If you go to page 34 of the latest 10K, you'll get a full breakdown of the situation here with Hingham. But essentially Hingham does take on deposits, a lot of which can be pulled out at any time, but they do have some, CDs and slightly longer term, slightly stickier deposits, I would say, that are more difficult for customers to suddenly pull. But you're right, the interest rates on those deposits can change relatively rapidly, and there's a time lag for Hingham to roll that completely into their loan book. So if their costs are going up on the deposit side and their earnings from their assets aren't going up on the loan side, that can be detrimental to earnings as interest rates go up, and we've seen that impact Hingham in the last year or so. It can also be a positive for Hingham if interest rates are going down. We saw that in 2020 and 2021. Hingham's results were incredible because they had the cost of their deposits go down quite rapidly, and the earnings that they were getting on their loans, took a while to come back down. So it kind of works both ways for Hingham. There is a bit of a time lag for sort of the interest rates to change on both sides of the balance sheet. And it's not necessarily, I would say, the absolute level of interest rates that matters too much to Hingham. it's more the rate of change, either up or down, that impacts the earnings in the short term. Hingham did provide some pretty good sort of commentary on that in their latest annual report and their fourth quarter earnings. And like I say, if you jump to page 34 of the 10K, you'll get a full breakdown of exactly what the loan book sort of looks like for Hingham in terms of loans that mature or reprice in the next year or 2 years or 3 years or 4 years or even slightly longer term in some cases. Okay, next question is from Digby. I've got a bit of a triple whammy here. 1, will you do a powerlifting episode? 2, what is one of your best loved ideas you let go of last year or this year? And 3, best book you read in 2022. Okay, right, let's tackle those one at a time. So in terms of powerlifting episode, for those that don't know, I competed in powerlifting for a few years. I'm really not training a lot for powerlifting at all anymore. I'm fairly washed up in that department at this point. But what I will say is if you do have the kind of will to search through the archives of YouTube hard enough, you may in fact find some powerlifting episodes from me from back in the day. So I'll just leave it at that. They're really actually not too hard to find. So if you want to go digging for them, you certainly can. What's one of your best loved ideas you let go of last year or this year? I've been asked that a couple of times. I think I'm struggling for a best idea that I've got rid of, but there were certainly some ideas that were reinforced. So the importance of capital allocation, particularly, a good example is not just finding a business that earns a lot of cash flow and is relatively cheap compared to that cash flow, but just further appreciating where that cash is actually distributed after it's earned. Is it put into really, poor quality acquisitions? Does it go to share repurchases? Does it go to dividends? Does it go to debt repayment? That can have a significant impact on your investment result. So that's probably an idea that was reinforced. And best book you read in 2022, I just had a look at the bookshelf before I read out this question. It would have to be probably The Snowball by Alice Schroeder. It's a pretty well-known biography of Warren Buffett's. It's a behemoth, but it's very good. One that I've been meaning to read for a while. So that's definitely a good one. Maybe honourable mention would be Am I Being Too Subtle by Sam Zell or The Outsiders by William Thorndike. I read all of those books last year and they were fantastic. So hopefully that answers a few of your questions there, Digby. Another question here actually on Hingham, this time from Carlos. Hi Tom, regional banks have been feeling some pressure since the American government said that they will backstop all deposits for banks that are too big to fail. According to last year's report, about 60% of all Hingham's deposits are fully insured. Do you think there's a risk of Hingham's losing a significant portion of their deposits in favour of a big bank? How bad would it be for Hingham? Yeah, that's interesting. I haven't seen that 60% number before. If you could maybe comment on the video and let me know where that came from, I'd be interested to hear that. Again, I kind of dug through some of the reports for Hingham before this video and couldn't find that. Hingham have it kind of plastered front page on their website that they actually do have quite a unique deposit insurance structure. They have the $250,000 FDIC limit, which is across basically all US banks. That's a pretty well-known one. But they also have something called DIF insurance coverage, which is actually like a weird specific to Massachusetts banks insurance coverage that they have. And they basically say on the website, our deposits are insured in full up to any amount because of those two types of insurance. So that's how I understand it. But I'd be interested to see where that 60% certainly came from. I think that unique insurance hopefully does provide Hingham a bit of an advantage, but in saying that, we should have Hingham's annual meeting due probably in the next few weeks. I'll be quite interested to see if we get some commentary from management on that. I think it will be probably quite a key focus in this year's Hingham annual meeting, if I had to guess. Question here from Carol. Kia ora Tom, haven't heard you mention A2 for a while. Any updates to your thinking on this? I've actually just switched to using it in my flat whites after reading a bit more about milk proteins. Well, that's very good. I still have a very, very small position in A2. It's not particularly meaningful at all to the overall portfolio, but it has been in there for a little while. I still hold it, haven't added to it or sold it recently. My thinking on A2 hasn't changed too much. The next couple of years in the kind of recovery of potentially the Daigo channel, the kind of Daigo reseller channel, I think is still going to be quite important for A2's results moving forward. Just following along with what's happening in Australia, we've got Chinese international students starting to come into Australia and that type of thing again, which is likely a tailwind for A2 and the Daigo channel. But they've certainly had a rougher couple of years. I still think it's a very good business. They have next to no debt, a lot of cash, very high returns on capital, and still some good growth opportunities. So I haven't done anything with it, but it's not a huge position. So that's why I haven't seen much from me on it. My thinking really hasn't changed too much. Question here from Louis. Tom, will we ever get to see your stock/life, including house equity portfolio or just the Clona portfolio? Yeah, it's a good question. I at one point thought that I may share my actual portfolio at some point. As the channel's grown, I've become more and more hesitant to do that, mostly because I really don't want to influence people to focus or, buy or sell any particular stock. We can even see in this Q&A, we've got a few questions on Hingham Institution for Savings because I've talked about it a bit recently. So I'm becoming increasingly cautious about talking about individual stocks in general, to be perfectly honest. So it's probably not something you'll see from me, at least in the short term, but never say never, I suppose. The Shameless Cloner portfolio, there's some overlap between my actual portfolio and that one, but that is really just an experiment for the channel. That is certainly not my personal portfolio or anything like that. The stocks I've looked pretty hard at over time, and one specifically that I was a day or two away from buying probably, it actually ended up just out of pure luck getting bought out and the price running substantially away from me, which was a very, very small company, and I've really completely avoided talking about those types of things on the channel for some of the reasons that I just mentioned. I've looked at very small companies, we're talking like $10 or $15 million market caps in Australia and that type of thing. So if I do ever talk about individual stocks on the channel, they tend to be at least in the several $100 million, if not billions or tens or hundreds of billions of dollars, again for some of the reasons I've just mentioned. So I probably wouldn't expect to see a full kind of portfolio or anything from me anytime soon, but yeah, like I say never. Next question is from Mike Geo. On the last Punch Card podcast, you said you sold off a decent amount of your SRG position for opportunities in other stocks. My question is, what percentage did you reduce your SRG position by, and care to share the other opportunities? For some of the reasons I just mentioned in the previous question, I won't mention the opportunities, but yeah, I sold all of Seritage. I rolled it into two stocks. They're both companies I've talked about on the channel a fair bit, so nothing too obscure in there. But essentially, I'm in a position personally now. We bought a house towards the end of last year, so I have a significant amount of debt for the first time in my life, really, and that means there's less cash available to buy new stocks if I'm interested in them. So increasingly, I'm having to look to sell stuff. That's probably the first major sale I've had to make to buy into new opportunities or add to stocks that I want to add to as prices have come down, and also as the portfolio grows in general, my annual savings are going to become less and less meaningful, probably relative to the portfolio value. So again, increasingly I will probably have to sell things. Seritage was an example of that. I wouldn't rule out getting back into Seritage at some point if I thought it was a reasonable opportunity, if the price came down a little, or if we got confirmation of their distribution range. Even as recently as last week, I think Seritage came out and gave a bit of an update to investors on their liquidation progress to date, and they have said a couple of times now, basically, if current market conditions persist with the real estate market, that is likely to impact their distribution range. So there's a bit of uncertainty there, and I just felt like it was a position in the portfolio that was large enough to give me the capital to buy the two stocks that I wanted to buy fairly recently, and it was also one that probably had waning conviction for for a couple of reasons, but one of which was obviously some of the updates coming out of Seritage, where they're specifically saying that if market conditions persist, then they'll struggle to pay out the distributions that they had initially expected to. Okay, question here from Banksy. Hi Tom, I remember you sharing in a video way back you had purchased a property with your girlfriend. Do you have any thoughts on investing or buying more property anytime soon? Perhaps you weren't interested and maybe have changed your mind to look into property sooner rather than later. Yeah. As it currently stands, I really have no plans to buy any more property. I think real estate in New Zealand is ridiculously expensive relative to the cash it throws off if you're looking to buy rental properties and that type of thing. Increasing interest rates more recently have made that equation even worse. A lot of people are, starting to get worried about decreases in real estate prices. Recently, I think in Wellington and the residential market, for example, we're down about 20% from the peak, which sounds like a lot, but the debt servicing costs have gone up substantially more than that with interest rate increases, which again means that if you're looking to lay out money to get more money back later, which is exactly what investing is all about, I don't really view New Zealand real estate as particularly attractive. I do have an episode of the podcast coming out very soon. It may even be out by the time that this video is out with Jack Duffley, who is one of the guys on the Punch Card live stream channel that we have, live streams on every week. He's actually kind of ventured into buying some private businesses. I've sort of been looking a little bit at some local private businesses, nothing particularly serious at this stage, but I'm kind of just looking at what's out there, and that's something that I'd really be much more interested in than buying additional property. So at the moment, it's just the place I'm filming this video from and the place that we live in terms of the real estate portfolio. No plans to add. Of course, if conditions changed with pricing and rental yields and that type of thing, I would of course change my mind. But as it currently stands, we're a fairly long way away from where prices would probably need to get to for me to be interested. Okay, next question is from Lilo Master. Are you attending the Berkshire meeting this year? If so, is there any way we could do a meetup? I would love to attend the Berkshire meeting this year. Unfortunately, I won't be making it there in 2023, but I plan to be there in 2024. Certainly would love to do a meetup of some description next year, but we'll have to plan that closer to the time, I think. Unfortunately, no plans to be there this year. I'll most certainly be watching it in the early hours of the morning on my laptop, but wish I was there in person, but not this year, unfortunately. Question from Kaz, which Kaz has actually given us an answer already as well. Hello, Tom. Question: why do ducks have tail feathers? Answer: to cover their butt quacks. Don't really know what you want me to say about that, but good question and good answer there, Cass. Let's do this last one from Ben. What value for barber? Sure. This is one I've been thinking about a bit recently. I most recently did the numbers when the share price for Alibaba was about $85 per share a few weeks back. I looked at it on sort of a free cash flow yield basis. So the way I would approach this, without kind of giving you specific numbers on exactly where I'm at the moment, I've sort of always focused on the China e-commerce business as the basis for most of Alibaba's intrinsic value. It's the kind of engine within Alibaba that earns basically all of the free cash flow, even more than 100% of the free cash flow, because it helps to kind of subsidize some of the loss-making businesses currently at Alibaba. So I've kind of gone through, I've looked at the last 12 months free cash flow, I've subtracted the stock-based compensation, because that that is a real cost for shareholders. And then I've looked at the free cash flow yield that I was currently getting, or at the time when the price was about 85. You could do that same maths for where the price currently sits today. One thing that will also change the equation a little bit is whether you want to include the net cash on Alibaba's balance sheet. The yield will be quite different if you were to do that calculation on an enterprise value basis and account for the net cash that Alibaba have. But that's kind of how I'm thinking about it, at least as kind of a floor valuation valuation for Alibaba is just to focus on the free cash flow that's currently coming out. That free cash flow is probably depressed a little bit, partly from those loss-making businesses, and partly because it's been a rough year for Alibaba in general because of some of the kind of macro conditions that have happened. So there's lots of stuff you can potentially add to Alibaba's like floor valuation in that way. They've also got, the stake in Ant Financial and a number of other investments as well. But without giving you a specific number of, I think this is the intrinsic value for Alibaba right now, that's kind of the way in which I'm thinking about it. Okay, so those are all the questions we have time for on this video. Thank you very much to everyone who did ask a question, and thank you for watching this Q&A video. Like I said towards the start, if you want to potentially get a question in a future Q&A, turn your notifications on for community posts here on the channel. That's where I always collect the questions for these videos. But that's it from me, and I'll see you on the next one. Cheers.